Hello, everybody. Welcome to another installment of Paladin Financial Talk. I am Matt Bryant with Paladin Financial, and today, of course, Tony Shore.
I'm here. I'm excited. I'm ready for the show, Matt. I drank 40 to 50 cups of coffee.
Good. I need your energy higher.
Preparing for the show today. So,
before we get started, I listened to last week's show.
Yeah.
When you did it with Jeff Quick.
Yes.
He was stepping in for me.
Yeah.
I believe you said the show has gotten too big for me.
Did I say that?
Is that what you said?
That might have been Jeff Quick who said that.
Okay.
No, Jeff actually said that. That was Jeff who said that.
You went along with it.
Oh, I'm more
any reluctance.
Yes.
Okay.
Jeff said it, and I'm like, yes, he definitely,
absolutely right.
He definitely has gotten too big for the show. He's moved on. We were joking.
Of course. Everybody loves me.
You noticed that, huh?
Uh-huh.
That's awesome.
I listen to these podcasts.
Wow. Okay. Because usually when somebody different comes on, if we have Jeff Foley, then I make fun of Jeff Quick. If we have Jeff Quick, I make fun of Matt. So you guys are catching. I didn't think you guys
didn't think we actually listened.
Yeah,
so.
That's the problem.
And
I've got to watch it, and I tell everyone they're my favorite host.
Yeah. Well, we all know that's a lie. So a little financial lesson from last week. So I missed because my truck wouldn't start in the morning.
Yeah, you had some car trouble.
Yep. So got it fixed and whatnot. But because I have emergency savings, I was able to pay it and move on without putting on a credit card, without disrupting.
Without the high interest credit card debt,
Yep.
24 to 30% credit card interest rates right now.
So those emergency savings accounts we've been talking about.
You guys, you really hammered that home. You've got to have an emergency savings. You've got to be disciplined about putting money into it.
Mm-hmm.
For that exact, you have a great example. Your truck broke down, and it's not cheap to fix either.
No, did not want to pay $2,200 on a Friday afternoon.
Oh, ouch.
But
ouch, that stings.
I could pay it and move on, and I'd have to worry.
That's good.
Where it's coming from. So
didn't have to run up a credit card debt.
Taking my own advice. That's the
Look
key.
at that. That's good. And that's the problem I run into with some professionals is they're good at giving advice, but they're not even taking their own advice. So if it's not good enough for them to do it, or if they don't have the ability to, so that's a great example. Mm-hmm. You live how you speak. And I like that.
Yeah.
That's good. That's really good. So the topic for today, solving financial challenges. Mm-hmm. And we all have financial challenges.
And also I have bad posture and severe financial problems.
That's good. I'm going to sit up straight.
Yeah, sit up straight. Well, you don't need to worry because you are the
Financial Panther, eh?
Matt's the Financial Panther.
Never been called that.
And I know the rest of us.
And also I have bad posture and severe financial problems.
We're here to solve.
We're here to solve
That's
that.
right.
We're here to solve that. Maybe not the posture, but you're working on that too.
Okay,
I like that. I like that. I appreciate you listening to last week's show.
Me too.
I can't believe you did. I didn't know when Jeff Quick hosts. I didn't know anyone was listening to those. But that's great to hear that people listen to Jeff as well.
We just need to check up on him.
I'm just teasing. He's great.
Conveniently, he's in Costa Rica this week, so
he won't hear that.
Yeah, he won't hear that.
He won't hear that.
We're good.
Okay, so let's talk about this topic. Where do you want to begin?
So October is financial planning month.
Yes.
Which, big holiday month for us.
Yeah.
Financial nerds.
Not that it's a holiday you can take time off. It's actually the busiest month.
Yes, it's the busiest month for us.
It is.
He talked a little bit about what is a fiduciary. So someone who is legally obligated to put your client's best interests first. So we're not doing what we do with our interests first. It's always the client's. What I wanted to start off by talking about is knowing where and from whom you are getting financial advice.
Yeah, that's big.
Most everybody out there has received financial advice at some point. You need to know what that person's objectives are in giving you the advice, and then how are they licensed or registered. And there's three main types that we see. One, insurance agents. So life insurance, annuities, there's other types as well, but licensed as an insurance agent, there's registered reps, which you hear as, brokers is what, colloquially we'll hear. And then there's investment advisor representatives, which are investment advisors that are fiduciaries. So what you want to do is take a look. How are those people registered? With insurance agents, you can go to the state website. So for example, the state of Minnesota, you can look that person up to see if they have that licensure and if there's been any actions taken against them. Registered reps, same thing. You can look it up through FINRA. It's called Broker Check. You can see if there's any disciplinary actions in their past. And then you can also see if they're licensed as a fiduciary, and that's through the SEC website. So this person is giving you advice, it's impacting your nest egg. You want to know, are they licensed and acting as a fiduciary, or are they representing a company and acting in that capacity?
Yeah. Well, that's really good. I'm glad you brought that up because, you do have to be careful if the person giving you financial advice and you're solely listening to them and they're not a fiduciary or an advisor, a financial advisor, if they're just selling insurance. Not that that's not important. No. We need insurance. We need insurance people and insurance companies. But if that's their main goal, they're probably not helping you maximize your Social Security. Mm-hmm. They're not held to the fiduciary standard of looking out for your best financial interests. And they're not necessarily looking at the big picture. They're looking at your situation saying, here's an insurance policy that would be suitable to you. And same with a broker. You might work with a broker who's not a fiduciary, who's just investing your money in the stock market, and that's what they do. Mm-hmm. So, if all you have is a hammer, everything looks like a nail.
Yes, and it's not that necessarily those things that they offer are bad, but
because you recommend those things to your clients all the time. Obviously, investments you do as an investment advisor, and insurance. Sometimes you need life insurance or cash value.
But you want to make sure your person is fiduciary,
right?
And putting your best interest first is the key part of that. So anytime you get advice, look that person up. Everybody's got that tool in their pocket. They can just pull up their phone and type it in. But it's important to know, especially when you're considering this is money for a lot of folks that have been saving for 30, 40 years.
Yep.
You probably want to know who that person is giving you advice.
Yeah, for sure. Great point. What's the next point you want to cover?
All right. So we're going to talk about defining financial objectives.
Okay.
So when we sit down with folks, we can't solve any problems without knowing what the financial objective is. Now, that seems very simple, but there are things we look at like risk tolerance, how old you are, what types of assets you have, what some of your long-term financial goals are.
Sure.
But we can't actually solve or fix anything for you if we don't get to know you and what your actual objectives are. I can say, generally speaking, if you're younger and you have an aggressive risk profile, you should be invested in these things over here. But without sitting down and actually peeling back the layers of who you are and what your true objectives are, like none of that advice means anything. For example, let's say you're 28 years old, you've been working for a few years, you're starting to build a nest egg. Maybe you're living with mom and dad or you're renting. You sit down with an advisor and do their risk assessment. It says you're aggressive, which makes sense because you're young and you've got years and years and years. Well, if they don't know that you're also looking to buy a house in 2 years because you're 28 and you're looking to start a family and have a house and whatnot, that aggressive allocation doesn't make sense for that chunk of money that's earmarked for your house. You don't want to take your down payment money that you need in 2 years and put it in something that could lose value if the stock market goes south. So
good point.
There's all kinds of competing interests when we sit down with clients. Some is short-term money earmarked for that car purchase or that house purchase. Other money is, I got 30 years before I retire. How do I make this nest egg grow as much as possible? So we really have to dig in and learn what the financial objectives are, not just take some quizzes and say, here you go.
Yeah. And I know a lot of your clients and folks you meet with are my age, 55 plus. And so they're going to look different and they might have different goals. And, when they need their money is going to be really important from what you're saying.
Yeah, some people want to get out of the workforce as soon as possible. 60 years old, I'm done. Others say, I like what I do. I don't, I'm doing this until I'm 70 or I can't anymore. So it looks different for everybody.
Sure.
Generally, there's, some similarities, but without diving in and knowing that specific person, how can you build a true plan?
Yeah. I would agree. I think that's really good. So you have to define those financial objectives or look at people's goals. If somebody said, we want to retire in 5 years and we want to buy a huge RV bus and travel the world or travel the country, right? Travel the US in a giant RV. Well, they're going to need a certain amount of money right away. And then you're going to have to come up with a plan that accounts for that, obviously.
Yeah, absolutely. And Ellie is going to talk about robo advisors here in a week or two. And, with technology, those models tend to be, let's answer some questions and here's your portfolio. But there's so much more nuance to it.
There is.
Yeah, generally speaking, you need to have some money growing long term, but you also have things you want to do in the short term or medium term. So how do you actually build your plan to check all those boxes, and how do you manage it on an ongoing basis so that, okay, we knocked out the RV, you bought that, but every time you have to fix something on an RV, it costs $2,000. Like, what are you doing to keep funding that lifestyle with also keeping an eye in the future? So a lot of competing interests. Where are you going to live in retirement? Are you staying in Minnesota? Are you going someplace that's more favorable from a tax perspective and where there's no snow? Like, what does it look like for everybody? And those are questions we really dive in on.
Sure. I think that's good. And everybody's situation is different. What's the next point to financial challenge that we need to solve or look at today?
So when we do sit down and meet with somebody, it's, hey, why are you here? Like, top of mind, what are the things that you want addressed? And, maybe it's the RV or health expenses in retirement, whatever it may be.
Sure.
So then we start diving in and learning more about them. So the risk assessment is important. It's a very simple tool to complete, but it drives so much of the conversation. And how do we actually build your investment portfolio? And it's based on how you score on that risk assessment. So we're looking at that. We have some other risk exercises we do in conjunction with that to help us get a feel for who you are as an investor. And if things do terribly in the stock market, how are you going to react? Do we need to help protect you a little bit from that? Or are you the type that's going to be fine no matter what? So getting a number, explaining to you what that number means, and then building a portfolio that reflects that number, and not setting it and forgetting it, but circling back on a very regular basis, redoing that score, seeing if anything has changed, making sure that we're tweaking the portfolio as necessary so it always fits your specific profile.
Yeah, that's really good. Again, really customizing it to the individual is what you're talking about doing, and dealing with risk and risk management. And that's so huge because, like you talked about in your example, somebody who's in their late 20s versus somebody who's in their late 50s, completely different risk assessment is needed.
Absolutely. And depending on the type of money you look at, if you're 30 years old and you have an IRA, you can't touch that money anyway, not without penalty. So that is going to look different than somebody who's 70 years old with an IRA and is using it to buy groceries or whatnot every month. So it's a big part of what we do is what types of money and what type of risk are you?
Okay.
So,
all right.
That's a big one. The age you hit on, the asset type is a big one. Managing those, that comes in with tax planning then. If you're heavy on pre-tax money, how do we diversify your tax structure so that you have other options as tax rates are set to increase? Do you have other buckets to pull from if some large expense came up and that you can tap into without any tax ramifications? So everybody's familiar with investing and diversifying your investments, but we also want to diversify your tax structure as
your
well.
Retirement savings is taxable in many cases. So I'm glad you brought that up because 401ks, 403bs, almost all employer-sponsored retirement accounts that people have nowadays, or they have a traditional IRA, a traditional 401k. Those are all, you get a tax benefit this year for the money
Right.
you put in. You don't have to pay
Mhm.
taxes on it, but it grows.
Yeah.
And it grows tax-free, but you pay taxes on all of it, including the growth when you take it out and need it in retirement, which is something people don't think about.
Right. And most people with their retirement, their 401ks at work, you set it when you started, and then you never look at your investments again. You
Set it and
probably
forget
don't
it
look at
is
your
what a lot of people
contributions.
do.
Those all started as pre-tax options. The Roth component's been added over the last couple of
Which is
decades,
nice.
but the vast majority of money we see has been largely pre-tax with a little bit of Roth. Until last 2 years, all those contributions from your employer were pre-tax. Now there's an option for Roth, but point is, you've never paid taxes on that money, and Uncle Sam and the state, they want their cut.
Yeah.
So they're going to make you start taking money out.
It's a joint account. My 401k, my traditional 401k is a joint
It's a joint
account
account.
with Uncle Sam.
Yeah, right.
I mean, which is a bummer, because if I'm just throwing out a number, let's say I had $100,000 in a 401k or traditional IRA, and I think I have $100,000 I'm going to use toward my retirement income. I don't. I
No.
don't have 100,000 because it's a joint account with Uncle Sam in a traditional 401k, and he's going to take 25, 30%.
State's going to get their cut
And
too.
the state, especially our state, will take
Especially
a
our
cut.
state.
You'll pay the state taxes. So it is good to have a tax-free bucket. And my daughter's 21 and she's got a Roth.
Yeah, that's
So,
huge. And
yeah.
you might ask, how does that tie back to my financial objectives? But when you look at whether it's short-term or into retirement, like how am I going to fund things, just retirement in general, it makes a huge difference if that $100,000 is $100,000 or if it's actually $75,000.
It makes a big difference.
And that's not a decision or a thing you can fix in the year you're doing it.
Can't change it.
You need to be planning for that in advance. So
Yeah.
it seems simple. This is what I need in retirement. I'm just going to pull it out of my account, but without planning, you can wind up paying significantly more.
Yeah, I've got a joint account with Uncle Sam, and he's not even my real uncle.
That's too bad, you know?
Yeah,
and we haven't even talked about Aunt Irma. Like, that's a whole another one. So
Uncle Sam and Aunt Irma. Yeah.
That's right.
Yeah.
They're coming.
That's true. They are coming for you.
So that's financial challenges, financial objectives. It's not just, hey, take a couple quizzes and here's your portfolio. It's really peeling back the layers of actually knowing who you are and what your objectives are, both short, medium, and long term, and then crafting a plan so that you have competing interests, but how can we help solve for all of those? And that's the big part of what we do.
Yeah. And I love that you take the time and have a few meetings to work out the plan and get to know your clients and prospects when they come in, and that you offer a no-charge consultation for our listeners and viewers out there.
Yep.
So we want to really recommend that. So you need to, there are things people can do, actionable things, and you can help them with that, right?
Yeah. Come sit with us for an hour. We'll get to know you. We'll actually show you under the hood of our process. You can see if it's something you want to pursue with us. But a lot of times we hear people don't want to think about it because they're worried about it, which seems counterintuitive, but I know that happens. Just ask the questions, have the consultation. Are you on the right track?
You'll sleep better at night, I'll tell you that. You don't have to worry. Not worrying about whether you're going to have enough money in retirement is huge.
You don't want to try to fix that problem when you're 70. You'd rather fix it when you're 50 or 55 or whatever. So that's what we do. It's sitting down with us at Paladin, finding out where you sit currently, what does that track put you on, and then what changes do you need to make to be out of the workforce and actually enjoying what retirement looks like.
All right. Well, Matt, I have to ask before we go, how can our listeners set up that consultation to get a plan in place or get a second opinion on where they're at and take that risk tolerance quiz?
Give us a call, 651-842-8406. Go to paladinfinancial.com and you can request a consultation through the website. There's a link on there to take the Color of Money risk analysis. You'll see it abbreviated as COMRA. But you can click the link and in 2 minutes you can have taken the quiz. And then we reach out to you and explain what that number means. And once we get to know you, see, are you hitting your number or are you off course, and what are some things to do to change? But call us 651-842-8406 or access us via paladinfinancial.com.
All right. Well, Matt, great show today. It was an awesome time. We had some fun with it, and it's great. And I can't believe you listened to it. We'll see if Jeff listens to this
right.
show. We'll find
I'm
out.
sure he's sitting on the beach in Costa Rica just waiting to listen.
I'm sure he is. Well, even Jeff Quick deserves a vacation, I guess. So great show today. That does it for today's episode of Paladin Financial Talk with our host today, Matt Bryant.